Here in KPMG, we take a multidisciplinary approach to the design and implementation of employee and executive reward strategies for our clients. So today I'm joined by my colleague Jim Calvert, who is going to share some interesting valuation insights for us. Jim, growth shares are becoming increasingly popular for employers. You might just explain what we mean by growth shares and typically how you might go about valuing them.
Okay, well, a growth share is a share that entitles the holder to participate in the upside of a company, of the value of a company, above a hurdle amount. The ways that we typically use to value them are either an option pricing method or a probability weighted approach. The option pricing method automatically generates a range of possible future values at exit and what the payoffs for management would be under each of those. Whereas the probability weighted expected method relies on management or the valuer to estimate explicitly what the exit proceeds would be to management under different scenarios and what would be the probabilities of each of those scenarios. So we typically would use the option pricing method because we think it's easier to support the inputs into it than the kind of fairly subjective inputs into the probability weighted method.
And over the years, Jim, you've naturally valued a huge number of kind of growth shares. What would you see as being kind of some of the key issues or maybe misconceptions about how you value them?
Management, one of the key misconceptions is that management sometimes argue that these have no values because of the hurdle that exists. And so the hurdle is generally set equal to the value of the company on the date the shares are issued. And so they will say, well, if we sell the company today, there'll be nothing left over above the hurdle. And so these shares have no value. But what that kind of misses is that growth shares essentially are a one-way bet. And so once you get above the hurdle, management will participate in the value. And there is typically plenty of time between the issue date and the exit date for value to accrue. And that value above the hurdle can get captured using those valuation techniques I just mentioned.
One thing, Jim, I often get asked from kind of a tax perspective is how often a client should revisit the valuation.
And the answer to that is it depends. So you want to look at when was the last valuation, when's the proposed date of issuance of the shares, and what has happened at the company or in the market on that. And you need to look out for things like recent financing rounds or things like that that might indicate a material change.
And when we look at the types of factors that you take into account when you do the valuation, what are kind of some of the main ones?
The first thing I would say is you really want to look at your valuation technique really needs to take account that these companies typically have different classes of shares with different rights, such as different liquidation preferences, different rights to dividends, different voting rights, and your valuation technique needs to take that into account. The other, another factor is discounts for lack of control and marketability, because these shares are non-controlling and non-marketable is typically a source of focus for these. And then a kind of third factor is when will an exit occur? When is an ultimate exit? And there can be complexity around that. Private equity and venture capital backed companies, it's pretty clear that they will exit, and it's a little bit less clear perhaps for family-backed companies that might stay invested in the company for longer.
So certainly a huge amount of complexity there and possible pitfalls for employers, so important to get that valuation input early on in the process. Thanks, Jim. And if you have any questions about any of the issues that we've discussed today, please contact Jim, myself, or click on the link for more information on our website.